Good morning, good afternoon, and good evening to all of you joining us from different parts of the world. My name is Carola Mejia. I work in the Latin American Network for Economic and Social Justice, LatinDat, and I have the honor to facilitate this interesting webinar titled Rebranding or Reshaping the Global Financial Architecture, MDBs Reform, Bridgetown Initiative, and the New Global Financial Pact. Muy buenos días a todas las personas que nos siguen desde América Latina y el Caribe. Este webinar será desarrollado en inglés, pero les invitamos a activar la traducción simultánea en el menú de sus paneles de Zoom. Encontrarán la parte de interpretación. Activan la opción en español y podrán
Please
escuchar.
activate your language options so that you can listen to the interpretation.
From English to Spanish, which you can activate in the Zoom panel. This event has been co-organized by Aerodat, LatinDat, the Bretton Woods Project, Christian Aid, CNCD 11-11-11, Deaf Justice, and the Feminist Action Nexus. On behalf of all those institutions, I want to thank you all for joining us today to develop a critical dialogue with distinguished experts on the current proposals to transform the global financial architecture, focusing on three interlinked initiatives that have been gaining a lot of track and attention: the MDBs reform, exemplified by the World Bank Evolution Roadmap, the Bridgetown Initiative, which is an evolving proposal introduced by the government of Mia from Barbados, and the new Global Financial Pact, to be held as a summit in June 22 and 23 in Paris, hosted by the French government. If these processes and initiatives are reshaping or just rebranding this urgently needed international financial architecture, it's something you will decide after listening to all the arguments, pros and cons that our guest panelists will wisely share with us. Before presenting our amazing panel, I'd like to give the floor to Jen Saldana, Aerodat's director, who will be giving us a brief presentation to set some key elements for the discussion. So Jen, please, the floor is yours. You have 10 minutes for this presentation.
Thank you very much, Carola, and I'm really happy to be part or to kick off this really fantastic lineup of speakers. Looking forward to the discussion. Friends, for good or for bad, the COVID-19 pandemic was a make or break moment. Many of us hoped that it would be a portal to a new world of greater equity and fairness. Unfortunately, although they are not the portal we dreamed of, the various discussions on global financial architecture that Carola mentioned in her introduction offer a new hope. But still, if we consider the reality, the question is, are these current proposals simply a rebranding exercise, or will they truly reshape global financial architecture? And I look forward to hearing the verdict of our three renowned panelists on this. To start with, I wanted to say a word about these three processes for those who are less familiar with them. First of all, the reform of the multilateral development banks, exemplified by the World Bank Evolution Roadmap. Secondly, the Bridgetown Initiative. And thirdly, the new Global Financial Pact, which is the expected outcome of the Paris Summit in June. So starting with the MDB reform, Multilateral Development Bank Reform agenda. As you know, Eurodad organized a webinar in April to explain this reform agenda, and you'll probably find the link in the chat box if you want to rewatch the recording. This reform agenda was kicked off by an independent review of the MDB's so-called capital adequacy framework, which was commissioned by the G20 in 2021. A draft evolution roadmap was then submitted to the executive board by the World Bank Group in December 2022, and this year an updated report was submitted to the governors in March 2023. The purported goal of this agenda is to ensure that the World Bank is up to the challenges of the current context, particularly around climate change or around fragility and global health threats. But of course, as always, the devil is in the detail. If you go through the technicalities of all the documents, you notice that there is an emphasis on increasing finance, but without requiring the shareholders, to contribute more. Instead, the focus is on relying on unused reserves, which is called callable capital, lending from capital markets and enhancing hybrid forms of capital, such as lending. There are some interesting features about this evolution roadmap of the World Bank, which includes labeling climate change as a global public good, scaling up finance from all sorts of sources of finance, and an enhanced role for the private sector in development, and a focus on middle-income countries. This last point overlaps with the Bridgetown initiative that has come up under the auspices of a small island developing state, which is Barbados. Propelled by Barbados' Prime Minister, Mia Mottley's critique of the obstacles that countries like hers face to raise finance for development and climate change, the Bridgetown initiative has gone through various changes. But in a nutshell, what it seeks to do is to break the deadlock in access to climate finance, particularly for countries like Barbados, small island development states. It proposes a global climate mitigation trust backed by a 500 billion special drawing rights fund for climate and development. And lastly, you have this Paris Summit on a new financing pact. It is being organized by French Prime Minister Emmanuel Macron, who claims to have taken up the gauntlet thrown by Mia Mottley. There are 4 pillars on which the summit is built on. First of all, fiscal space for countries facing short-term balance of payment difficulties. Secondly, private sector development in low-income countries. Thirdly, investment in green infrastructure, particularly for emerging and developing countries. And finally, innovative finance, particularly for climate change vulnerable countries. There's little detail about what will concretely come out of the summit, but many in civil society are very apprehensive given the process so far. There are not only apprehensions about the feasibility of the summit's ambitions, but there are also questions whether it is just a distraction from the real structural issues around financing for development. On the face of it, all 3 proposals seek to respond to today's context, given the protracted impacts of the pandemic, of the Russian invasion of Ukraine, and of the North's inflation containment policies and its impact on the global South. And if you look at it, there is a lot of similarity to the frenzy of activity that we saw post the 2008 financial crisis. If you remember, there were these discussions on financial transaction taxes, on the airline ticket tax, championed by the leading group on innovative sources of financing for development. But derogating from those discussions, what connects these 3 proposals is their seemingly blind faith in financial markets and the role of the state which is reduced basically to de-risking to facilitate more lending for development and climate finance. And this is a problematic singular focus on private finance that has increased civil society's concern for these 3 processes. This is especially given the case that none of these proposals have had any representation from civil society in their formation. Consultation after policies have been finalized does not leave much room for actually influencing their shape and for reflecting civil society's concerns. And one of these concerns is the expanded role of lending, especially in an era of high interest, piecemeal, chaotic, and high interest, as well as piecemeal, chaotic, and unending processes of debt restructuring. And there are fundamental questions that remained unanswered. For instance, is a bigger World Bank a guarantee for better and more effective development models? And what about the effect of the South-North bleed of finance, for instance, from illicit financial flows, from corporate tax dodging, from capital flight, from unfair trade and investment agreements? What about existing donor commitments on development and climate finance? Eurodad and our partners have developed a big body of work which shows that strong public financing and investment in public infrastructure and services governed democratically is a much more effective way of ameliorating poverty and reaching the SDGs. To safeguard against the well-established risks of private finance, especially in the context of the pandemic, we must recenter our efforts in invigorating public finance while also advocating for a multilateral system. We believe that the announced 4th Financing for Development Conference could provide a venue for a truly intergovernmental process that is transparent and involves meaningful engagement of civil society. I look forward to hearing the views of our panelists on this and all the other issues that we are going to be discussing this afternoon. Thank you.
Thank you very much, Jean, for this complete introduction. Now I'd like to present our distinguished panel, a panel made of 3 amazing women who will be developing all these topics Jean has just mentioned. I want to welcome Mariama Williams, Director of the Institute of Law and Economics in Jamaica, and a member of the Caribbean Feminist Action Network and the Gender and Trade Coalition. Mariana is a PhD and a feminist economist with over 20 years experience working on economic development, macroeconomic, trade, external debt, and finance issues, with a focus on gender equality and women's empowerment, social equality, sustainable finance and development, and climate change issues. Welcome, Mariama. We also have the pleasure to come with the presence of Daniela Gabor, who is an associate professor in economics at the University of the West of England, Bristol. She holds a PhD in banking and finance from the University of Stirling. Since then, she has published on central banking in crisis, on the governance of global banks and the IMF, and on shadow banking and repo markets. She works on questions of critical microfinance and de-risking development interventions. And finally, I'd like to welcome Liane Schalatek, Associate Director of the Washington office of the Heinrich Boell Stiftung, a German political party, a foundation affiliated with the German Green Party with 33 offices worldwide working on sustainable development, human rights, and gender democracy. Liane has more than 20 years of experience in global governance issues, specifically in international development and finance and international climate negotiations, where a particular interest of her work revolved around engendering macroeconomics and finance policy. She holds dual master degrees in political science, political economy, and international affairs. So we have prepared 4 guiding questions for our panelists to make this more like a dynamic discussion among us. And you will find these questions in the chat. After this round of questions and answers from the panelists, we will open the floor for questions from the audience, but we invite you all to write all these questions in the Q&A option in the Zoom panel. So please do that and specify who are you making this question for. So to start with this part of the webinar and to start with the discussion with our panelists, I would like to make the first question to Daniela Gabor. Please, Daniela. During the last World Bank and IMF spring meetings, there was a strong focus on the World Bank Evolution Roadmap, which includes a discussion on how to expand its financing capacity. What are the changes and continuities in the World Bank Evolution Roadmap that you see vis-a-vis the World Bank's group current approach to development finance that you, Daniela, have previously placed as part of the Wall Street Consensus? And how would you assess those with regards to advancing towards the Sustainable Development Goals and meeting the Paris Agreement, the Paris Climate Agreement? Daniela will have the opportunity to reply first, and I will invite also Liane to comment on what Daniela is going to say. So please, Daniela, the floor is yours.
Thank you. Before I start, 2 points. First, in true academic fashion, I brought slides with me, so apologies. I know the organizers wanted dynamism, so I'll go very fast through the slides. Second, I want to say that I'm very pleased that Liane is here from Heinrich Boell Foundation some of the original ideas and work that I've done on the Wall Street Consensus comes from Nancy Alexander, who used to work for the Henry Ford Stiftung in the US and who's been a guiding light on these issues. She's identified many of the challenges that I'm describing now way before they were mainstream, and I just want to honor her work now. Let's see. So, can you see my screen?
Yes, we can see.
Okay, so when I think about the work that the World Bank has done over the last, at least, let's say, since 2017 with the Maximizing Finance for Development agenda, I see a change in the nature of the development paradigm that the World Bank has put forward, away from transforming what we know as the Washington Consensus into what I called the Wall Street Consensus. And this idea that Jean already alluded to presents development or the achievement of public policy goals related either to the SDGs or to other public policy priorities. It presents them as a question of escorting private capital, particularly institutional capital, you know, like asset managers or like pension funds or private equity companies. So escorting this institutional capital into investable assets, into investable asset classes, into investable developmental projects. So you make an asset class out of education, out of hospitals, out of nature, out of forests, out of whales. There are many, many, many things that you can make an investable asset, of course, with participation from the state. And it is a Wall Street Consensus in the sense that it makes private finance or capital as a central to development initiatives, and it transforms the nature of the state into a state that is mainly guided by the question of how do we channel these, or how do we welcome these investors into our countries and into our projects. And before the World Bank published the roadmap, some of the work that I've done basically identified three broad critiques of this model. One, that it continued with debt-creating flows in the sense that it reinforced the structural vulnerabilities to what we call the dollar global cycle, to the fact that, you know, when the US Federal Reserve changes or tightens dollar funding conditions, then there is a structural pressure on countries in the global south that increases the frequency of external debt crises and also reinforces the imperative of market access. And if you look, for example, at the negotiations around debt restructuring on the African continent, but not only, the imperative of market access is always there, and it makes it very difficult to get investors to voluntarily agree to debt restructuring. The second problem that I identified has to do with who is in the driving seat of the development initiatives, and it's typically institutional capital. And that matters because development is not a macro-financial question anymore. It is a question of how do we de-risk investments. And third, and this is critical for a lot of the work that most of people in the audience is doing, are the distributional downsides. Basically, the project of creating a de-risking state and the project of guiding investments or private investments into new asset classes out of public goods de facto or indirectly privatizes and commodifies those public goods, and therefore it restricts universal access or it conditions them on cash flows. And then I looked at the roadmap and particularly at the Paris alignment provisions that the World Bank has published recently. And I will just give a very, Carola told me I have 6 minutes, so in 6 minutes I cannot do a lot, but maybe we can come back to it. Just to say that if you look at the Paris alignment provisions that the World Bank has published recently, we still have de-risking as the developmental model. There is still very much an emphasis on private capital, particularly institutional capital, will basically deliver on development gaps or investment gaps in any sector that you can think of. There is a question of green structural alignment. And I think the way in which the World Bank is now, through the roadmap, is organizing the question of, or the process of Paris alignment will amount to what some people already voiced a fear of green structural adjustment, in the sense that there are some conditionalities coming built within the Paris alignment of the World Bank's both development policy finance and investment project financing. I'll show you that in a second. And something else that I'm concerned with, because I've done work not just on, the de-risking as development agenda, but I've looked at high-income countries, the way in which they are organizing the framework for decarbonization. And what we see here is that the World Bank is creating already its own taxonomies for distinguishing between what are universally aligned projects and non-universally aligned Paris projects, in which basically it will have a lot of what I mean by epistemic guardian. It will have the authority to decide at country level, at project level, what is an activity that is conducive to either mitigation or adaptation. And this I've taken from the Bretton Woods project, from a conversation they've had earlier, and you can look at it. There is a process that the World Bank has just adopted, and from June 1st, 2023, so in 10 days from now, this will be built within all the World Bank's activities. And basically what it says is the World Bank will be Paris aligned from 2023, which is a very bold claim to make, given particularly the fact that the World Bank says non-aligned operations will not be financed by the World Bank. I'm not sure what this means in practice. I think the World Bank will say the World Bank will not finance any fossil fuel projects in the future. I'm not sure that it means that. I just had a very quick look, and I think this is something that I urge both scholars and civil society organizations to start studying, because as Jean said, the devil is always in the detail, and there is a lot of new detail of what the World Bank is proposing to do with its Paris alignment. And I just wanted to show you here how the World Bank is starting to think about how will it ensure that its loans and investments are Paris aligned. And it goes from very complicated definitions of what are green activities or Paris aligned activities and what are not Paris aligned activities, and the extent to which there are, for example, prior actions that are required for World Bank interventions or World Bank development policy financing, which may mean some form of green structural adjustment, in the sense that the World Bank could be able to say in certain conditions or in certain contexts, because it emphasizes very much country ownership. I have my doubts about the extent to which there will be meaningful country ownership at this level, but there is the concept of carbon sinks, for example, caught my eye, because I could see a future where the World Bank will say, you can do this natural gas plant, or you can do this we can open this new coal mine, but for this you will have to have a carbon sink in the form of a protected forest somewhere in the middle of a indigenous community, basically doing land grabbing. So there are all sorts of complicated issues that already the scholarship and the research on the Wall Street Consensus and on this push for nature as an asset class has identified. And I worry that the World Bank will amplify this. And I'm going to stop here, because I see Carola is already going past the 6 minutes. Just to, if we can come back to this, just to have to draw your attention to the fact that there are very, very rapid, I don't think that they are transformative in the sense that they will not generate a new development paradigm. They will not generate a new realignment of the macroeconomics and the financing questions away from what I call the Wall Street Consensus. We are still within the same paradigm, but some of the straitjackets on the ability of countries in the global south and governments in the global south to deviate from this approach, these straitjackets are being tightened with the Paris aligned World Bank lending and investment. Okay, thank you.
Thank you very much, Daniela, for all this information. I think it is very important to analyze it from an expert like you. It's always good to hear all these arguments. So I would like to invite Liane to comment on what you said. Liane, what do you think about what Daniela presented as these problems, these observations on the World Bank Evolution Roadmap?
Yeah, thank you very much. And first of all, I have to say it's really an honor to be part of the panel. And I have to admit, I'm a little bit intimidated. My focus is mostly, on some of the climate finance discourses. And so I think I'll probably respond or comment also with that in mind. But first of all, to say, that the Wall Street consensus that Daniela identified definitely is part and parcel, unfortunately, also of the wider climate finance discourse, and that also obviously reflects to the evolution roadmap discourse about increasing basically the role of the World Bank and other multilateral development banks in increasing climate finance provision, which is problematic from a number of points, not the least of which, and obviously we can discuss that in some of the later guiding questions more from a climate justice perspective, but absolutely want to mention it. And so in the sense that civil society that is involved in climate finance and related negotiation processes looks at that proposal of the World Bank roadmap, there is just big concerns about the World Bank being fit for purpose for doing that kind of climate-related financing. And that has to do with a number of issues. First of all, as Daniela mentioned, we are not even sure whether the Paris alignment means that there is no continued fossil fuel financing. And I would say it's quite astonishing that the proclamation for basically being Paris aligned and it taking effect for the IPRI, and I want to point out that it's at least 100% much later for the IFC and MEGA, is more than 8 years after the Paris Agreement was approved. And obviously, since then, the World Bank has continued to fund fossil fuel. I think by some accounts, it's 15 billions. Then obviously, and that's the other thing, it's not transformative in the sense that the World Bank and the roadmap continues to basically perpetuate a growth-driven economic agenda that does harm biodiversity. The word biodiversity, for example, does not, or biodiversity loss does not appear in the roadmap discourse at all. It further increases or builds on industrial agriculture and extractivism, on mining. It continues a focus on those enabling environments. Obviously, the leveraging, de-risking, and blending for the sake of the private sector engagement, not for the sake of the outcomes that we are looking for in the respective countries, but actually for the sake of the private sector. All this undermines what should be resilience building, addressing climate vulnerabilities of the poorest countries and the poorest population groups. And so I think to the extent that the World Bank actually looks at increasing its role in climate finance, this is extremely problematic. On a number of issues, we have very little transparency, and it cannot be verified by observers or by tracking actually how much climate finance is actually provided by the World Bank. The World Bank claims that in the last year, fiscal year 2022, they did about 32 billion, but they do not make their activity level data set that underpin those calculations available. There is quite a bit of work. Oxfam has done a study that the World Bank group tends to overestimate, significantly overestimate, some say by up to 40%, how much quote unquote climate finance they are providing. And then I think this is crucial when we are talking about indebtedness, rising indebtedness levels, high interest rate, the quality of climate finance provided through the World Bank group and the MDBs is very low. We have only 15% of their adaptation finance and less than 5% of their mitigation finance provided as grants. Only 23% of the climate loans are actually concessional, which obviously means that a lot of them are not. And again, this is incompatible with an understanding of climate justice and obviously counter to what you have as core principle under the UNFCCC that actually look at developed countries taking the lead in providing finance and providing finance in a way that supports including the right to development of recipient countries and actually not further restricts either their fiscal space or their policy and development space.
Perfect. Thank you so much, Daniela and Liane, for your answers. I would like to make the next question for Mariama. And I would love to also to hear comments from Daniela on what Mariana is going to say. Civil society organizations have raised concerns regarding the fact that most of what is being discussed in terms of new financing is in the form of more lending from multilateral development banks and more bonds in financial markets, thus worsening the already difficult debt situation, mostly in the global south. Mariama, do you agree with this concern? And how does your network perceive these three initiatives on the table regarding this? Please, the floor is yours.
Good morning, good afternoon, everyone. Thank you so much for the invitation to speak on the panel. I am actually very thankful for Daniela opening up. I thought she presented some really interesting things that we should have further discussion on. But like Liane, my focus in the last couple of years has been really not on on climate finance, so I'll speak to that. But I started out in this adventure of mine with global finance on debt and development. I did my dissertation looking at Jamaica and the impact of the transfer burden on the debt crisis on growth and development, domestic savings, and in particular, a marginalized community within developing countries. So it's kind of interesting for me to be back full circle on this. And so I'm very familiar with the work of Eurodad. Thank you for all that you're doing. And thank you, Daniela, for the great work on the Wall Street Consensus, which I've used quite a lot in many of my interventions the last year. We're at a critical juncture. I think there's a lot of activity. I mean, I've just even preparing for this, I've just been amazed at the amount of activities that are ongoing. But I still go back to the question of, the Marcon Summit, the Barbados Initiative, all speak to a lot of failure of what we have been striving to get in the last 20 years in terms of financing for development. We had the North-South Institute, North-South dialogue, which was about reformulating the financial architecture. That was stamped out and literally starved by the developed countries, most of whom are still, including France, which is now pushing this new financial architecture. The Bridgetown initiative fits very nicely, and I could see why people are engrossed by it, because it doesn't really far remove from the kind of trajectory that Daniela has talked about, right? We're in a world of bond financing. Yes, bond with a hurricane clause or a natural disaster clause, but we are in a world where we're relying on the financialization of development. In many areas, we talk about blended finance. It's a similar thing. It's the same thing that we're talking here. Now, I won't be representing a network position because we've not discussed it in any of the networks that I've been in terms of this presentation, but I'll just give you a perspective as someone who's worked in the South, both at intergovernmental level with the South Center in developing countries, and as an academic and as an NGO, and who works a lot with many women's NGO. We recognize that the debt crisis is I mean, I noticed that in a lot of the papers coming out from France, they talk about debt tension and don't want to talk about the word debt crisis. There is a crisis. There's a crisis unfolding. It's a crisis been unfolding in the Caribbean for the last 5-10 years. It's worsened. It's a crisis unfolding. We saw with Zambia. It's not tension. It's a crisis. And it's a crisis that has dire implications for the lives of men and women. These debts have been increasing a lot. And the more that countries have been pushed to go to the capital market, is the more we see the debt. There's a sense in which people think that bond financing somehow is not incurring debt. But actually, it's a pernicious form of indebtedness. And it's an indebtedness where your ability to restructure your debt is extremely limited by the number of participants, the fact that they can be held out, even within the proposal for Barbados on the hurricane clause, the natural disaster clause. If you go into the details of it, you'll see that Fitch has said that their hurricane clause will be approved on a case-by-case basis, but there's no necessarily guarantee that it will be allowed if there's not consensus among the bondholders. And that if there's consensus among the bondholders against the clause, it will be considered a default. So I urge people to really look behind these seemingly new and novel ways. Financial markets, yes, of course, the bond And the hurricane clause is actually transferring most of the burden back to the developing countries and not to the credit market. So they're quite okay with it on a case-by-case basis, and because they'll be backed up by their external governments. So I think it's very important that we recognize that the twin threat of the pandemic and climate change, the climate emergency that we're in, have, yes, dampened the fiscal space in developing countries, crippled and compromised social services, economic fragility, and increasingly political instability, and tremendous amount of criminality going on in many places. Where I'm from, Jamaica, that is definitely par for the course. We know for sure from the UN that the SDG at the halfway mark is definitely not on track to be in any way succeed, and that there is a new debt crisis. 52 countries, which are home to the world's poorest people, are suffering from severe debt. And many governments are spending 20% and up of public revenue on debt services. This will not change with bond financing. So bond financing pushes the can down the road, but eventually comes back again to bite us. So we're in a world where we're seeing rising indebtedness at the finalization of development. And we're seeing also the increasing push for climate finance has on the for the public sector, the private sector, but also within public multilateral financing, the tendency towards loans, which really means, again, climate is part of the debt crisis that's going to be evolving, unfolding in many countries. So I think that we have to be very careful, and we really need to look into the devil in the fine print behind these pronouncements and these seemingly fantastic approach. They're not new. None of it is new. It is recycling of old frameworks and pathworks that many of us have fought for since 1980s, right? The first debt crisis. We fought for it in the North-South dialogue. It came up again. It comes up again in climate, the discussions about. For me, one of the most troubling fact is this expansion of both the IMF and the World Bank into the development space, in coming through the lens of climate or through pandemic, because neither of these institutions are pro-development. They're there for specific purposes, and debt becomes a control mechanism. It always has been. It is not a mechanism to liberate anyone. It's a mechanism of control. So I think that for me, and I think many of the people I work with, expansion of the World Bank presents a moral hazard for climate finance and both for development finance. We cannot have this one mega entity being the conduit, the guarantor, the distributor. All of the things that we need goes through the World Bank and the various MDBs. I think we need some diversification of risk. I talk about de-risking. We need to de-risk development from the incursion and the intrusion of the World Bank and the IMF. So I find it particularly troubling. I think the Bridgetown initiative, the way it's been formulated, yes, it's a nice and new, seemingly new way of packaging a lot of things that were already on the ground. Okay, pandemic clause in a bond is not new. Grenada did it in 2015. Right? Barbados did not invent it. And the question we need to ask ourselves is that the whole idea of force majeure as part of financial instrument is in international law. Why has it never been applied in international debt situation? And I think it's great that Barbados has brought this out, and with the credibility and the influence of Mia Motley, we see more discussion of it, and we see what we need to see is more multilateralized discussion around force majeure in terms of natural disaster and so forth, not just simple case by case. I think what I'm concerned about is the underlying, the response and the recognition of the Barbados, the Bridgetown initiative, great, but it fits in within a paradigm. It fits in within the neoliberal Wall Street consensus paradigm. And that's why it's been so widely accepted and everyone has jumped on board, because it's not a path out of and towards a new paradigm. It fits in with the conceptualization that Daniela has laid out. It's complementary to that process. And it doesn't takes us in a transformative direction. A transformative direction takes us into a whole multilateral approach to looking at debt, looking at the way that debts have been accrued, the way that we manage debt, and the way that the ODA financing is has been looked at, the way that the $100 billion in climate finance. So what one of the things for me that's I'm concerned is that some of what's been talked about is taking us away from climate justice, right? It's taking us away from climate justice, from the whole idea of polluter pays. And it's become this kind of benign thing. Oh, we're all in this thing. We're all going to be saving the world. And this is how we do it. We bring in bonds with these pandemic clauses. That does not change the underlying structure of indebtedness. Even debt for nature swap doesn't change the impact of sovereignty. So who determines where the residual payments or the leftover payments or the leftover from the debt, the discounted debt, where does it go? It's already predetermined by the creditor, whether it's an NGO as TNC or others, they already predetermine where the money will go. What if that's not what the people need? What if the people actually need for there to be water casement built, for there to be climate proof agricultural storage for their food? What if that is what they need? So all of these mechanisms, again, are drawing away from sovereignty, from democracy at the grassroots level, and they're attributing them to financiers, whether bondholders as private investors or bondholders at NGOs or bondholders in the multilateral development bank. So it's still part of this financialization of development. And I think we have to be very careful, and we have to go back and relook at it. What some of these proposals have been on the table for a very long time, from the north, south, what is it that make them more amenable now? What is it that makes it more fitting that the global community is running to laud it? What is it? And we need to always pay attention when that's occurring, because we have to see where the gaps. There are certain commonalities, there's some innovativeness. Yes, I like the packaging, I like a lot of it, but we always have to question why and where are we going with this, and what's happening to the discussion in the UNFCCC around finance and around 100 billion. And the OECD report will say that we're short 16 or 20 billion. We're not short 16 or 20 billion. The promise was 100 billion per year by 2020. So every year that was short, that should have been carried over. So if they were short 20 billion in 20, and we're talking about from 2010, every year there was a shortage. So that should have accumulated. So we're not shortage by 16 for 2020. We're shortage for every year. It's a promise. And so the past predicts the future in many ways, unless we are able to change that trajectory. And right now, I don't see us doing that. And that past tells us that promises are made, new initiatives are lauded, and then we get to struggle around the implementation of it. And does it actually help the persons on the ground? And I'll throw that in for the time being and come back to you.
Thank you so much, Mariana, for this very important concerns, inputs, and I would like to hear also what Daniela has to say about this. And you, Daniela, have more time now to complement what you were saying at the beginning as well. Please go ahead.
Thank you. And let me start by apologizing to the translators. Disculpen for my speed in the previous presentation. And also let me congratulate Mariam for being so insightful and incisive. She told us she has jet lag. I can't imagine what you are without jet lag, if this is how you perform with it. I think you made some very important points, and you reminded us first that bond financing is not a magic cure to any kind of structural systemic problems of debt vulnerability and debt crisis. Quite the opposite, it accelerates and sharpens them. And you can see that, I mean, I'm always very puzzled why we focus so much on China's lending to the global south, when private bondholders are a far more complicated and very significant obstacle to debt restructuring and debt resolution for countries in the global south. But okay, there is a geopolitical question there that maybe we don't have time to address here. I think Mariam also reminded us that we should be worried. I mean, I also ask myself sometimes, we should be worried about what we ask for, in the sense that, do we really want the World Bank to be able to expand its balance sheet, to leverage its capacity to lend, to escort more private bondholders into climate finance or to all sorts of other initiatives. Because if it becomes, as Mariam has pointed out, if it becomes a how did you put it, a conduit and a generator, and in a sense a gatekeeper for the structural transformation of and decarbonization projects for countries in the global south, that is a significant question that is not, doesn't have a, I mean, from where I come from, I grew up in Romania. I underwent at least 12 IMF standby agreements, and I don't know, around 5 World Bank structural adjustment programs. My experience is that you should not want them in your country because that's a bad sign. They will shape the developmental trajectory of your country in a very significant way. And I wanted to say something about why I think also there is a question, and I salute, and I hope if you have written this down, Mariama, I would very much want to, read it and disseminate it. Your critique and careful engagement with the Bridgetown initiative is one of the most astute that I've heard. I think it looks on as an initiative that is trying to reclaim sovereignty for countries in the global south that has been chipped away by decades of all sorts of neoliberal or other kind of initiatives. And it's not very clear to me, and here I share your concern about the extent to which it just repackages some existing ideas into more politically appealing offers. What I don't see, and this is something that we have discussed in Europe, at least at the level of central banks and to some extent ministries of finance, the approach that we have in Europe towards capital is to give it a lot of sticks now. Everybody, both in Europe and in the US, a lot of carrots. Everybody's giving tax incentives, preferential loans, subsidies of millions of forms in order to try to incentivize, compete in a global race for green technologies. And what would be great to see in the Bridgetown initiative is something that Europe had at least 5 years ago, which are sticks. We need more sticks for bondholders, more sticks for private capital. It cannot be that we have now ended up at the mercy of private financiers for achieving any kind of public policy goals. This is why I said in my first slide that development is a macrofinancial question, in the sense that it very much depends on the kind of macroeconomic paradigm that you operate with, the kind of state capacity that this allows you to have. If you operate under the old neoliberal Washington consensus paradigm that says you have to have a independent central bank that targets inflation and welcomes private financial flows into your economy with all the kind of systemic vulnerability that creates, then obviously you're not going to be able to create fiscal space. Fiscal space is a political construct. It's a political construct that gets shrunk by the presence of private bondholders, particularly foreign ones. And there is a long debate to be had here, but I stand by this reasoning. And to me, I would very much want to see any possibility for the Bridgetown initiative to also contemplate sticks for bondholders and for private capital, not just carrots, because if we compete over how many incentives and subsidies we can give to private capital, then countries in the global south are not going to come out winning from that competition. That means higher and higher debt burden, higher and higher fiscal costs for de-risking, for achieving through private capital what should be done through public ownership. Okay, I'll stop here. Thank you.
Thank you both for your comments. Liane, the next question is for you. Considering you have been following the climate finance negotiations very closely, do you think that the new Global Financial Pact Summit and the Bridgetown Initiative will influence the climate finance discussions under the UNFCCC? And what is your opinion on the role they are giving to the private sector as this magical solution to close the financial gap?
Yeah, thanks so much. I think the short answer to the question is, do you think Pact Summit, Bridgetown, are they influencing the climate finance discussions? They already have. They are distracting, and I completely agree with Mariama from what should be the core focus of the UNFCCC climate finance discussion, which should be focusing on the core fundament of equity, common but differentiated responsibilities and respective capability, and what is at the heart of the UNFCCC mandate to developed countries, namely to supporting developing countries through their obligation to mobilize and provide climate finance. They are also accelerating a trend, and I think I mentioned that, and I completely agree again with also what Mariama and Daniela have already said. What we could also call the Wall Streetification of the UNFCCC climate finance discourse. And that really further undermines the role and the importance of the UNFCCC and related discussions on climate finance, not to mention that obviously the call for increasing climate finance to go through the MDBs means that less climate finance is going to go through the UNFCCC funds. And obviously, if we look at the question of who participates in decision-making on climate finance, and you look at the structure of the MDB decision-making versus, for example, a UNFCCC climate fund on decision-making, which has equitable or at least equal representation of developed and developing countries in decision-making, that further underlines basically the injustice, the climate injustice that is furthered through providing climate financing outside of the UNFCCC, but also by increasing that Wall Streetification of climate finance provision in the UNFCCC. One of the things that I think is very important is obviously one of the advantages of Bridgetown Pact and the World Bank evolution roadmap discussion was, or seemingly is that repackaging that moves a little bit away from the income classification, you know, as the core eligibility criterion for climate finance. And I think this is probably one of the plus points of the Bridgetown initiatives that you obviously highlight, that climate vulnerability and the fact that this should have a large impact on the level of concessionality that you receive for financing support should be at the forefront. However, and again, that goes to the criticism of the Bridgetown initiative that Mariama has articulated and that I share. If you look at Bridgetown and the Barbados proposal, it obviously helps Barbados in arguing for accessibility, eligibility based on climate vulnerability. But then again, the Bridgetown initiative focuses even for adaptation on loan provision instead of grant provision. So all of that, I think, actually the climate finance discourse in the UNFCCC, where the discourse is increasingly about financing tools and instruments. So the blended finance, the public-private partnerships, the levering the private sector, the asset classes, and it's less and less focused about developed country responsibilities and public sector finance provision. So the financialization becomes the goal, the outcome, not what should be people-centered, human rights compatible, gender responsive climate action for which the finance is needed. So there is still that understanding, and I think that increasingly comes also through in the UNFCCC, that there is some trickle down of climate finance that eventually reaches affected communities and marginalized population groups. And we see that filtering in all kinds of climate finance discussions that are ongoing. We see it in the 100 billion discourse, which is still not reached. And again, this is a compounding shortcoming. We see it in the discourse for the new collective quantified goal, where developed countries are putting an effort forward to frame all of those discussions into the discourse about paragraph 2.1c, meaning making all financial flows consistent with Paris Agreement, but again, distracting from the core provision We see it in the Green Climate Fund, unfortunately, which is the largest multilateral climate fund. It's currently seeking its second replenishment, where the discourse about programming priorities is, for example, on climate resilient infrastructure as an asset class, where you see a lot of focus of de-risking, leveraging the private sector through equity investments, with the GCF being the anchor investor, assuming basically a lot of the risk. And instead we see it in, for example, a programmatic proposal for its funding decision that has very little focus on a community-led, a locally-led adaptation in making financing directly accessible to affected groups. We also see it, and I think this is the discourse that is very important also in the discourse about the new funding arrangement for loss and damage and the new loss and damage fund, where there is a push by developed countries to not only restrict the scale and scope of what the loss and damage fund could look like, but actually argue that there is already so much happening, including in the multilateral development bank, that even if you have a fund, you could potentially tack it onto something, maybe even as a special trust fund, yet another special trust fund under the MDBs. And so all of that, I think, plays very much so into the agenda of developed countries, and does so in two ways. It detracts, again, from their own responsibility of providing public finance as core financing to fulfill their responsibilities under the UNFCCC. And then second, it also allows the global North financial players to profit directly. And that's the institutional investors that Daniela mentioned. It's the major corporations, it's the large commercial banks. It's also the developed country development finance institutions, development banks that are all working in coordination and cahoots and furthering that agenda. The last thing I want to mention, and I think this is really important, is that when you look at plurilateral initiatives such as Bridgetown initiatives, or also the Macron summit, for me, there is the core question of legitimacy. Who gives Macron the legitimacy to basically convene that summit, draws it out of, for example, UN systems where you have, and we heard already the shortcomings of the participation, the limited opportunity for civil society inputs, but also the limited opportunities for a lot of countries and developing country to input. Yes, you are highlighting Barbados and the Bridgetown initiatives, but do all developing countries have an equal voice in those discourses? The missing follow-up, right? So we hear a lot of pronouncements, but how will the pact summit be structured? How will accountability for whatever might be recommended be achieved? So I think those are some of the core issues. And lastly, maybe I want to say with Bridgetown in particularly, I think when you look at Bridgetown 2.0 and some of the newer pronunciations of it, I think one cannot really escape the notion that despite the strong moral standing that Barbados and Mia Mottley has, nevertheless, you are still there faced with the reality of the power dynamics. And so some of the bolder visions of the Bridgetown initiative, like, for example, the 500 billion in unused SDRs that were supposed to go to a global climate mitigation trust, do not even appear in the newer pronouncement of the focus on the priority of Bridgetown 2.0. So there again, the reality of who holds the power and who is not willing to share and defer power comes into play. Thanks.
Thank you very much, Liane. I would like to invite Mariama to step in and comment on what you said, considering she also has a lot of experience in climate finance. Mariam, very briefly, please, your comments.
Yeah. It's difficult to comment on Liana's because Liana, I fully agree with everything that Liana says. and Liane has been following a lot of the discussion more intimately than I have. I'm kind of arm's reach out of that process. But I want to say two things, right? The caution that Liane raises about the evolution of what will eventually be the Bridgetown initiative, because it's evolving. And we know from history, we know from global politics, I've been in UNFCCC, I've seen developing countries raise issues that get attention, and at the end of it, it's not what they raise. For example, the CDM mechanism in the UNFCCC, when Brazil raised that, that was meant to fund development. By the time we got it implemented, it was about the West being able to use their carbon, to ease their carbon footprint, and by passing it into the developing countries. So it's not exactly what was started. And my concern on the Bridgetown initiative is exactly what Liane is saying, is that by the time it gets, and what we're presented with at the final Bridgetown initiative will be so watered down that the transformative element will hardly be there, but it will be the Bridgetown initiative. And countries cannot walk away from it, because the history is that our countries don't walk away from anything, because now it's Bridgetown, right? It's Barbados, it's a small island, so we keep it because we must keep it, even if we don't like it and we don't think it's the most horrible thing, we will keep it, you know? So that is my experience in this fora. So we need to, as much as we can, wherever we can, if we can, to make sure that a lot of the integrative part of it stay there, and it doesn't get watered down and become something that's just this translucent thing that has the name. But the other thing that my fear and my concern with it is that if you look at what's been put forward, and in particular, I go back to the bond issue, right? That it is making climate finance about, if it's for grants, it's about a narrow set of deservers, right? Vulnerable countries. But they're vulnerable people in all developing countries. And I raise that question because I was particularly caught by a caveat in the Fitch determination, where it says, Fitch's ability to rate future bond issue with natural disaster clause will depend on their specific provision. We would not expect to rate such bonds from highly rated issuers, which means that countries that have high income, to me, higher income, or countries that you don't necessarily like, you won't give them that disaster clause, which is why I keep saying that this has to shift from an individual case by case to a multilateral discussion about force majeure, natural disaster, climate, and so forth. It cannot be that we're going to contain it into a small group. And the tendency of developed countries is to try to get their obligations to the narrowest, smallest group of countries. So if they can limit it to SIDS, and even the poorest among SIDS, they will gradually water it down to that. And we have to be careful, because the majority of poor people live in middle-income developing countries. They live in India, they live in Pakistan, they live in other places. So we have to also be very careful that this doesn't just become about SIDS, right? I am from SIDS, yes, SIDS is my heart, but there are men and women in the broad swath of developing countries who are vulnerable on different levels of what vulnerability is. And also, who determines this level of vulnerability? Who at the end of the day will do these risk assessment and so forth. So I think that I want to put that out, because that's one of my big bugs in going through some of the finer details of some of it. I think climate finance is always about an equity issue within, and should remain a discussion where the greatest number of developing countries are participating and have their voice. And that this far has been the UNFCCC, right? We've seen how it turns out. We see the GCF. We know that GCF 1 replenishment, where a lot of that were loan. And I think the process going on now, we'll see a lot more loans in it, which means that co-financing become a big thing, which means that debt, and if you get loans, then you pass loans out. You're not going to get loans and pass grant. It just doesn't happen that way. And we're seeing blended finance, where we blend the finance so that the grant element is about preparing the ground for the finance, not even about the country. It's preparing the ground for the corporates to be able to enter and do what they need to do, so that they don't have to take a huge amount of risk. So co-financing, which becomes a burden on the country, because most developing countries borrow their co-financing. If you're in Asia, your co-financing is from the Asian Development Bank. If you're co-financing in the Caribbean, most likely you're also going to be co-financing again. So everything comes back to the MDBs. right? The more we push the private sector, the more we push the loans, the more there's co-financing, the more there are other kinds of things. You have to prepare yourself for a bond issue. You just don't wake up one day and say, oh, by the way, I want a bond, right? So you have to make fiscal changes, pretty much similar things that you would do to welcome an IMF agreement, right? It's not comes without strings that are not free, right? And so I think we really need to interrogate these very, very carefully, what we agree on. In terms of, I don't know if we're coming back to the Markan Summit, because I really do have a lot to say about that. But for now, I will just leave it that way. I agree with Liane. Climate finance, we cannot uproot it from the equity base in the UNFCCC. We cannot uproot adaptation from its grant funding, its granted route. We cannot, loss and damage also, we cannot be talking about loans and bonds for loss and damage. We have to go back. So the more we push this thing out of the CCC and into other dimensions, MDB area or G7 or G20, is the more we're in the world where we're coddling finance. I love Danielle's term, escorting the investor. She has a really great term that I like, and I wish she'd repeat it again. But I also use it somewhere else, so I'm familiar with it. So yeah, so I'm going to stop. Also, get my head.
Thank you so much, Mariama. I will make a last question for the three of you. It's regarding governance. There are a lot of civil society organizations that believe that these initiatives fall short of our own understanding of reform. What are the challenges that you see from a governance perspective in these three initiatives in view of reshaping the global financial architecture in the interest of human rights and climate just-based development model? We will start with Daniela. And very briefly this time, please, you have 3 minutes each, please. So we have time to respond to the other answers, the other questions too.
So I don't know, maybe this is not necessarily a good question for me, because I'm not quite sure I understand what you mean by governance. If what you mean is in what kind of spaces should we push for what kind of reform, then to me, the Macron summit, and maybe we should discuss more the Macron summit because it's coming. And I think one has to ask not only why it's not going to work, but I think the equally interesting question is why is it happening? And why is it attracting such high stakeholders, such powerful stakeholders, in the sense that, you know, Brazil, Lula is going to be there, as I learned, the Bridgetown initiative is going to be there. So yes, it's away from the UN. I think Mariama, with this signals to me that space is not a space that is going to generate any kind of it has lost any kind of momentum, significant momentum for shaping, you know, global elite responses to questions that are also geopolitical. And I think maybe we should also bring geopolitics in here. I think the geopolitical tensions and the struggle over particularly green commodities in the global south. These are very relevant. And I read the Macron summit in that key, not necessarily that, you know, it's some a strategic initiative against the UN-led spaces or against multilateral spaces. Is, you know, it's geopolitical power plays from Europe. I would be interesting to see what Liane thinks Germany's role is in there, in the sense that, you know, Germany has done a lot more the technical work of de-risking or of pushing de-risking, particularly on the African continent, where I'm more familiar with, having done work with Ndongo Sambasila from Senegal. So I would just, in terms of governance, I mean, it's interesting to, maybe the other two panelists can answer better this question, but to me more interesting is the geopolitical power struggles that explain the momentum, particularly behind Macron's summit and the way in which he tries to appropriate the Bridgetown agenda and probably, you know, inflate it or water it down or reorient it into some direction that is more palatable to countries in the global north.
Thank you very much, Daniela. I will pass the voice to Liane.
Yeah, thank you. I was also struggling a little bit with the question, and I think I partially answered some of the parts already with my previous question. So the governance challenge is obviously to the extent that you push more and more into the World Bank and the MDBs and the IMF, where you basically have decision making depending on stakeholder developed country or global north interests, with, you know, much less participation of global south. And I want to point out in the World Bank, both in the pact summit And in the World Bank evolution map, there is no reference to actually reforming the governments of the international financial institutions, right? In Bridgetown 2.0, this is mentioned as one of the 6 principles, but as we are talking about what gets picked up and what gets left behind when proposals that are coming from developing countries get watered down, I would venture to say that significantly reforming the governance structure, the voice, vote, and participation of developing countries in the MDBs and the IMF is probably not going to be the core priority of the discourse. So that is obviously one of the issues. And then when it comes in terms, if you think about for core principles for accessing and governing both development finance and climate finance, there should be the equitable representation in decision making. Financing should be adequate and directly accessible for those most affected, should be transparently provided and accountable. It should be following a human rights-based approach. It should be supporting gender equality. It should have country ownership at the core, but country ownership that is a little bit broader defined than, for example, a ministry of finance or a development ministry, but really kind of a country ownership as a citizen ownership. So that should be prioritizing local ownership and subsidiarity. And I don't think in any of those proposals put forward that comes to the fore. It's not even mentioned. It's not even an afterthought. It's not a thought at all. And so again, this is a perpetuation of pretty much the same structural model of decision-making, of power, with a couple of tweaks, and certainly not what we are looking for.
Thank you, Liane. Mariama, please go ahead.
Okay, so I'll try to be quick because I really agree with everything that's been said before. I take it some of the governance is about the reform of the IMF and the MDB, especially in their direction to be funding climate. For me, the reform of the World Bank as envisioned in whatever the evolution and the roadmap is just that. It's tinkering with that institution. It's an institutional level reform. I think if you're talking about a transformative approach to a multilateral governance, including the Multilateral Development Bank, then you first have to do it. The World Bank has been in operation for over 50 years. I would have see a comprehensive review, not of its capital adequacy, not of its relationship with the market, but of what its development impact has been. What has it done? What does it achieve? Poverty, what is it? And I have never seen a review of the World Bank. We evaluate everybody else. If you go to a foundation, you must review your program, what you've done. So we're constantly building World Bank, and we're constantly adding and talking about adding more money and extending them. But there's been no attempt by any institution I know of to review the work of the World Bank in terms of what it's doing at the development level, what it's achieved. I think that's the first step towards if you're going to reform. And then for transformative things, you need to put in all the things that Liane has flagged. Human rights, you cannot go along with saying that you're not obliged to follow human rights because you're a financial entity out there on your own. You're part of a global system, the financial architecture, governing people's lives. So human rights, women's rights must be essential. So all of those core things, the core, any programs and project you're going to be fund must follow core international rules and laws as laid down by Human Rights Convention, ILO, and all of the various principles. And we just don't follow trade rules and the IMF. Secondly, for me, the Macrofinance Summit, I come to the question of legitimacy. Who is France to talk about engineering a new pact of finance? When France has ended its disastrous relationship with Haiti in terms of the odious debt, and repaid and repatriates that, when it has cleaned up its relationship with the CFA in the Francophone Africa, in terms of it still being a guarantor and still being drawing money out of that, when France has met its 0.7% of GDP, I know it has like a domestic commitment to 55.5%, but when it has done all of those things, then come talk to me that you're an honest broker talking about establishing a new intellectual, a new financial architecture. When you refrain from making your donations to the GCF as loans, and if you go back to the replenishment of the GCF, and France is one of the countries that much of its thing was in form of loan. I do not know the second round, what's going on, but France has been pushing loans into entities that are supposed to be doing that. When you've done all of that, and when you've advocated around the $100 billion from Europe, then you come and talk to me that you're a serious, honest broker about forging a new path for the North and the South to talk about development. Until then, there's no legitimacy. So, and I know it's going to happen, but, those are my conditions, my preconditions for talking with this. There's too much going on. There's too much cloud, too much that's obscured to talk about that and not deal with the reality of how you operate in the world, where poor people live, the poor people that you're caring about live. And that will be mine on that.
Thank you. Thank you so much.
Multilateral debt relief system, not this piecemeal approach. We have enough talk about it for many years, both from the IMF, both from the developed countries in Latin America and others who've been pushing for multilateral process. These are the processes that will serve us best, not these piecemeal ad hoc things.
Thank you so much to the three of you. We have received more than 15 questions from the audience, and we have selected 3 for each one of you because of the lack of time we have. But I will request the panelists, if you can type answers in the Q&A section to the people, that will be amazing. So I will start with the first question for Liane. There seems to be a tension between what Liane just said, not wanting more MDBs funding, and ask for low-income countries for additional grant or concessional finance for development through the MDBs. It is just that we want the MDBs to stay out of the climate finance and stick to their development role, which they are also doing not great at. So Liane, please go ahead very briefly.
Yeah, I think the baby is already, in the bathtub, and the water is already pulled out of the bathtub. So MDBs are in climate finance, and they are unfortunately here to stay. They also have a role, and we have to be very clear and honest about that, as the core implementers of climate finance under the UNFCCC funds. So, even if you have, for example, a Green Climate Fund or the Adaptation Fund or the GEF, the World Bank and other multilateral development banks are still there as accredited entity. However, again, decision about who receives funding and on what, on what funding proposals is not done by the MDBs, but is obviously done by more equal or equitable representation. I think personally, I would like to limit or at least prevent an expansion of MDB so-called climate finance, because again, the question is really with some of the difficulties of, and transparency of what they are terming as climate finance. I think there's a lot of inflation of their role, but I think they have a responsibility to provide all of their development finance, and including at the highest concessionality level, and that includes obviously more grant financing possible in a way that is completely aligned with the climate mandates, both in terms of mitigation as well as adaptation. And I think personally, I would see a much bigger role for the MDBs if they could participate stronger in some of the debt relief and debt forgiveness, freeing up some of the space, than actually trying to expand lending in the name of providing climate finance. So that would be my answer to that.
Perfect. Thank you so much, Liane. The next question is for Daniela Gabor. Sorry. MDBs are being positioned as the best way to increase climate funding to developing countries due to their concessional terms, high credit rating, etc. But they have this overwhelming private finance focus and all the new aspects you have just highlighted. So what recommendation should civil society make on MDBs reform that are equitable and transformational and can meet the financing needs of the Global South? Daniela, please go ahead.
Thank you. I mean, I'm always in two minds, and I don't know if I'm the right person to answer this question, because when I studied, I did the master's in development studies a long time ago in The Hague, where I learned this phrase, better exploited than excluded. And it always comes back to me every time we think about the questions of reforming institutions that have been part and parcel and have been instrumental in pushing a particular global economic order, in sustaining an international financial architecture that benefits global capital, that benefits capital in the global north, that reinforces unequal ecological exchange. So I don't know what the answer to this is. Is it better to just critique from the outside, or think that there is some meaningful scope for marginal reform? I would say, and I answered, I think in one of the Q&As you will see there, I answered that if we are not happy with throwing, stones from the outside in the tent, and we want to be in the tent and try to change the dynamics inside, for me, there will be three things. The first one is we have to push, and I would push for no de-risking of social infrastructure and biodiversity. This should be off the table. Health is not an asset class. Education is not an asset class. Well, I mean, biodiversity, forests are not an asset class. Some things should not be, some public policy priorities should be outside, completely outside the scope of de-risking. And I think if we push the World Bank on that, that would be a good first step to say not everything should be commodified or made investable. The second step, or the second part of this, to somehow take a strategic advantage of the fact that the World Bank is working on its Paris alignment framework, and to say we want the World Bank to build national capacity in the state for evaluating the World Bank's or responding to the World Bank's Paris alignment criteria. How will we know when the World Bank engages with a country, when it decides to give a loan or to invest in a project? How will we know that there is adequate monitoring and accountability for the way in which it decides that that project is Paris aligned? I'm not quite sure that we know that. And I don't know that many countries have the capacity, and I'm including here, just both global north and global south countries, because this is a very complicated debate once you get into the nitty gritty. And I suggest to the listeners, if you want to look at, for example, the European Commission Sustainable Finance Taxonomy, which is doing kind of the same things that the World Bank's universally aligned activities is doing. There is a lot of debate, and the scope for greenwashing in Paris alignment is massive. So we need national capacity. To me, the question that we have now on the table, given the particular geopolitical context in which we find ourselves, is if everybody's back to doing industrial policy and everybody's back to reviving a state that has a closer relationship with private capital than the neoliberal agenda allowed us to believe that is possible, then do we have a technocracy, and do we have institutional capacity in the state to do the kind of things we would want to do? Because, for example, in the conversations on reparations, or in the conversations on, even if we erased all debt of countries in the global south now, the systemic structural drivers of indebtedness are not going away. You will have the same problem 2 years from now coming back, because we don't have national sovereign developmental models that can, change the parameters of external vulnerability. So we need the World Bank to train, if that's possible. I'm very skeptical of this. I'm just putting it out there. If you want to push for something, I have never seen the World Bank doing any meaningful training on industrial capacity or state ownership in countries in the global south. I've seen China doing more of that than the World Bank. Whether this is a strategic battle civil society organizations want to undertake, this is up to you. I have no particular strong views. I know that I am skeptical of it, but I will stop here.
Thank you so much. We have a last question for Mariama. Is it possible or useful to counter the skirting of private capital via de-risking, via reviving government, the market, via regulations of foreign investments? For example, joint ventures with domestic business partners, transfer technology, local content requirements. Mariama, please, you can step in to answer this question.
Yeah, I was just scrolling through. I finally found the Q&A and just scrolling through it, and I saw. Thank you, Bhumika. What my answer, of course, is yes. I mean, I think we have gone far afield from planning our national economies, from taking into account our resources and our both those on the ground, on top of the ground, and those of our people. And we've gone so far into inviting foreign capital. So it's not new. The World Bank hasn't invented it, nor has anybody. Our countries, I could speak for Jamaica and the Caribbean, we were weaned on foreign investment. We were created by foreign investment, right? So that there is that natural tendency to want to go to foreign capital as opposed to doing national work and domestically orienting. And certainly it is the case that how we approach this quote blended financing and how we approach the push towards PPP, which themselves are ultimately going to be leading to debt, as the IMF has noted in prior paper, that PPP themselves can constitute issues for the balance, local and national government balance of payment, balance sheet. So yes, there is room for significantly mobilizing and partnering local capital with high regulation of capital that comes in. But as we already know, at the same time we're going in this discussion, there's a discussion in the WTO, which is completely wiping out the possibility for countries to do that. And additionally, there's investor state provisions in investment trade agreement that actually blocks government from doing that. So the whole system is definitely encircling us in ways that are detrimental to this kind of development ethos of focusing on growing the national economy from the inside out and using strategically foreign capital, foreign assistance, so that we have countries that are totally dependent for the healthcare in the Pacific and others on foreign assistance, as opposed to developing. And at the same time, we have brain drain going on from many of our professional classes moving to different levels among Caribbean, among the Commonwealth country, and then to the US and Canada and so forth. So yes, if we're gonna buy this escorting of the capital, then what better to do than to do that with your local capital and to highly regulate those who come in. But we know that even from internationally, the US is having problems regulating its capital. So I'm not sure how we go about doing that for governments who are already reluctant because they're entrained outside. And now the MDBs, as they come in with the green finance and the green structural adjustment, will be bringing more and more of that under the umbrella of blended finance or PPPs or these bond financing. So yeah, I would agree, but I don't know how we do it. You know, that's where I'm always stuck. How do we move out of this?
Thank you very much, Mariama. Unfortunately, we ran out of time. Sorry if we couldn't answer all the questions, but we want to thank our amazing panelists for joining us today and for enlightening us with their knowledge, their personal opinions, and on these three initiatives and processes that have gained a lot of traction and attention to different stakeholders in the past months. I'd also like to give a special thanks to Stephanie Derlich and Polina Girshova from Aerodat and Aerodat's team for their work and support in organizing this space. A special thanks also to Constanza Evans for helping us with the interpretation. And sorry for speaking too fast. And to all the people who made this webinar possible. Soon we will share the recording of this webinar with all of you, and we hope we can still organize more of these debate spaces to discuss about these alternatives and proposals for a new financial architecture. A real one. Have a nice rest of the day, and thank you all for being here with us today. Thank you and goodbye.
Thanks all.
Thank you very much.
Bye-bye.